One, welcome to chapter 2 in Reals Earnings Management. So here we are going to look at RAM or Reals Earnings Management model and some of the examples as well as some practical implication when applying this model. So Reals Earnings Management model. So the RAM is defined as the sum of abnormal cash flow from operations, abnormal discretionary expenses, and abnormal production cost. And one of the famous model is Patsukata Roy Chowdhury earnings management model. So this is the formula. So RAM is equal to abnormal cash flow, abnormal discretionary expenses, and abnormal production cost. So this is the most simplified version of this model. But in chapter 3, we will be exploring on how to derive all these components and how to calculate them. And in chapter further, like 4, we will be looking at a practical example of how this is done. So when it comes to REM or discretionary accrual method, REM is superior compared to accrual methods because after the Sarbanes and Oxley Act implemented, when all these scandals happened like Enron, they put implications and audit procedures in practice to detect accruals. However, real earnings management is still far more effective in detecting earnings management. But a warning, when you are a research student, undergraduate, master's, or a research scholar, using REM is more complex and complicated compared to accruals method. It will take more time and it will take more amount of work. So when is REM is not suitable in research studies? So REM model cannot be applied to businesses which are in the industry of banking, finance, and insurance because they do not have a certain assets classification, discretionary expenses, production cost expenses. So these cannot be included. So if you are planning a sample study or if you're collecting data, and if your sample comprises of these industries, you cannot apply the REM model or the real earnings management model, even the accrual model. There will be complication because you will not be able to find enough data. Same thing will be applied to other companies in your sample data. If you cannot classify the expenses or you cannot segregate, you cannot differentiate discretionary and production cost, then the REM model cannot be applied. So do keep in mind when you're collecting data for such instances. So what happens after like real earnings management or if there's real earnings management found in a company? So firm's reputation, public image will be lost. And most importantly, the trust of customers, the trust of shareholders, suppliers will be lost because management has adopted some bad practices to manipulate their earnings management to achieve their personal goals or some other financial monetary benefit. Again, this will eventually lead to decrease in market value, sales, and eventually the bank the company will be bankrupt and they have to close it down. So the practical examples. So this is not a comprehensive, but just to give an idea of how the management is doing such earnings management practices. So usually firms structure their transaction by using different time points to realize expenses to achieve a preset accounting result. So they can delay payments and they can put fictional payments, timelines, to just to manipulate. So some examples are delaying fixed asset maintenance, delaying operating expenses, putting off salary increment, payment of bonuses, delaying taking on potentially profitable capital investment projects. So this will be harmful in the long run for the organization. And these are the references used for this slide. And this is just an overview and theory side of the this video series. But if you want to go deep into the only you want to know the calculation part, just go to the chapter 4 of this series, where the data calculation, data collection, and how to manipulate the data in terms of statistical analysis will be explained through Microsoft Excel. Thank you.